Hello and welcome to this Tolley Seminars Online lecture where I'm going to be looking at a summary of the responses that HMRC have given to the recent consultation exercise on Making Tax Digital, or MTD as it's now been affectionately called. My name is Chris Jones. Now HMRC, at the 11th hour of their imposed deadline of the 31st of January, so in other words subjecting themselves to a deadline which is imposed on the rest of the profession for the response that they were going to make to the Making Tax Digital consultation. And they met that deadline with just 12 hours to go. So not quite the 11th hour, but certainly the 12th hour. Now, unlike submitting a tax return, much of their response, or parts of their response, leads us to some areas of TBA where some detail is yet required, but nonetheless, the overall response HMRC has given is reasonably comprehensive. So what we now have in our possession is HMRC's responses to the 6 consultation documents which were released on the 15th of August last year, and the consultation process, as you may remember, closed in early November. They've also published draft legislation and tax impact notes for digital reporting, the cash basis and property profits. The lecture I'm about to give is based on Andrew Hubbard's article, which will appear in Taxation on the 9th of February 2017, called Ploughing On. So first of all, let me summarise the key points, many of which I'm going to go into much more detail in the rest of the lecture. The key points to bear in mind are as follows. Firstly, the Making Tax Digital plans remain very much the same, including, unfortunately, the mandating of digital submissions. In addition, there appears to be no change to the timetable imposed, in that sole traders will be required to move to digital reporting from April 2018. However, there is some relaxation of the penalties in the first year. I will cover this in more detail later. One notable change is that HMRC will now accept MTD compatible spreadsheets. Now, it's not simply any old spreadsheet, they do need to be MTD compatible, and I will explain what this means very shortly. They have left us with a little confusion over the year-end submission date for the truing up of the 4 quarterly reports into an annual submission. I'll explain this shortly. We are awaiting more information on the turnover limit for the deferral of introduction of MTD for smaller small businesses, but as I say, we don't know quite what that means as yet. We're waiting for more information. HMRC have confirmed there will be no requirement to keep invoices and other documents in a digital form. What they are basically saying is that sole traders will not have to scan in or photograph copies of receipts or invoices as part of their digital record keeping, but they will be required obviously to include the fundamental financial information in a digital format. HMRC have confirmed there will be increased piloting in 2017. If that goes well, of course, that will mean that the rollout will be on track. HMRC have also confirmed that there will now be a formal exemption for the digitally excluded, i.e. those individuals who are unable to submit in a digital format, and to define what that is, mainly people where it is impossible to file digitally due to the restriction of broadband availability. And HMRC have also confirmed an extension of the cash basis. And in this lecture, I'm going to go through the main key points where things have changed following the consultation process. Records and quarterly reporting. HMRC, as I mentioned before, will now permit the use of spreadsheets, and this was always a controversial point because many small businesses do use spreadsheets to keep their underlying financial information. And HMRC is now saying that this will be acceptable, but there is a but to this. The but is that the spreadsheets will need to go through some form of MTD compatible software, which will turn them into a useful submission for HMRC. The quarterly updating will require income and expenditure to be split into specific categories. Although HMRC have not categorically stated this, I can imagine that what they mean is that the income and expenditure is split into the boxes that we currently have in 15 to 31, of the current self-assessment tax return, which I will just outline to you now through the overlay to this screen. So what are included in boxes 15 to 31? And I will point out where this might need a little bit of updating. So this is exactly what HMRC state at the moment. We need to state what our turnover is. In box 16, any other business income not included in turnover. Then 17, the cost of goods bought for resale or goods used. 18, the construction industry, payments to subcontractors. Box 19 should include any wages, salaries and other staff costs. Box 20 should include car, van and other travel expenditure. 21 is rent, rates, power and insurance costs. 22 is allowable repairs and renewals of property and equipment. 23 is the most interesting one for me. Phone, fax, stationery and other office costs. Interesting there, because they're not actually updating that to include, for example, the cost of broadband, which is what MTD is fundamentally based on. I don't know anyone who possesses a fax machine these days, but surely that should be phone, broadband, etc. 24. Advertising and business entertainment costs. The emphasis there on allowable business entertainment costs, of course, will only be for staff. 25. Interest on bank and other loans used, of course, for the purposes of the business being undertaken. 26. Bank, credit card and other financial charges related to the business. 27. Irrecoverable debts written off. 28. The most important one in my mind, accountancy fees, but also legal and other professional fees, of course, those that are allowable as a revenue expense. 29 will be depreciation and loss of profit on sale of assets, which of course are tax adjustments in themselves and replaced with capital allowances. Box 30 includes other business expenses, and 31 of course is our total expenses, which leads of course then to the overall declared profit. Now, what this may mean for some businesses is that the modifying of the existing spreadsheets may be required in order for that business to be compliant, because many businesses may not actually include their expenses in those categories. And the key question is for some businesses, will the actual shoehorning of their spreadsheets into this format be as useful business information for the business owner? That is a good question that only you can answer when speaking to your own clients. But clearly, businesses keep records not just for submission to HMRC, but for their own purposes to help them run their business. And we will need to help our clients in a transition from where they are now to where they're going to need to move from April 2018. Let's turn our attention now to spreadsheets and software. Spreadsheets will need to be maintained in real time to keep records. And they are not just summaries of paper records, for example, just simply taking the totals of a handwritten up cash book. Quarterly reporting will not require the tax adjustments on a quarterly basis. However, businesses are free to do those adjustments, but they are not going to be a requirement of MTD. These could be left to the year-end submission, where we take into account all the 4 quarterly reports and do the annual adjustments, where, for example, we would add back depreciation and replace with capital allowances. However, if you have a business where they're eligible for 100% initial allowances or annual allowances, etc., it may well be worth claiming the capital allowances in the quarterly report. The software must be more than just an electronic postbox in order to turn what is a normal Excel business spreadsheet into something which is going to be useful for HMRC. So it will need to include a basic level of prompts and nudges to ensure that the taxpayer, when they're completing the submission, are being prompted and nudged to make sure everything's complete, and also perhaps to deal with some obvious errors which the software will pick up as the information is keyed in. HMRC have confirmed that they will not be providing this interim software, the software that links the spreadsheet to the MTD database. This will be left to the private sector to produce that software, and HMRC have confirmed that free software will be available. It won't be particularly complex, but they are leaving the private sector, and that we know that HMRC have been meeting with the software providers to discuss this, but they will be leaving the commercial providers to provide a free level of software. How useful that will be, well, only time will tell. Businesses with turnover below the VAT registration threshold currently only need to provide 3-line accounts in respect of filing of their SA returns, and to HMRC's credit, they basically said that those businesses will also only need to file 3-line quarterly reports in line with the 3 boxes relevant in the return. So that is quite useful to see. So what is the quarterly reporting timetable? Well, HMRC have confirmed no movement here, in that the quarterly reports will be due in 1 month from the end of the appropriate quarter. Now, this is quite a tight timetable. I know it's the same as the VAT reporting timetable, but many taxpayers, with regard to HMRC in particular, reporting of all their expenses and profits, will, I'm sure, want their agent to check their submission. This means that the timetable is quite tight, especially where businesses are not necessarily keeping all their records absolutely on time. So you could find businesses that basically are concentrating on running their business, not particularly keeping up to date with their sort of including details on their spreadsheets or accounting software, and they have a mad rush to key in all the information, get it over to their agent, and for the agent then say, yes, this looks all right, file it with HMRC. So for some businesses, this will require quite a significant change to both the way that they run their business and, of course, the way that we run our practices to ensure that we are geared up to deal with these 4 times a year reporting, plus, of course, doing the annual truing up. So this could be, in some cases, quite a dramatic shift. HMRC are still adamant that very little is involved in making a quarterly update, and I quote directly from their response in this overlay. Updates are intended to be quick submissions of receipts and expense data that reflects the trading recorded in the business's records. The month's submission period is not intended to be a lengthy window of time, which a business starts to enter all its transactions in the digital records from paper. If a business has been keeping digital records as they go, the update should be straightforward to generate and send. And the point I made earlier is the point about if at the beginning of that last sentence. If they are. Believe it or not, many businesses are frantically trying to run their business. Keeping their records tends to fall to the wayside sometimes. And therefore, if businesses are not keying information as they go, this will be quite a dramatic task. At the end of each quarter, they will actually have in 4 times a year a month of mad panic where they're putting everything into their appropriate systems. So helping our clients actually keep records as they go will be particularly important when they move to digital. Let's turn now to the submission of the annual truing up, the annual summary of all 4 quarters reports that form the basis of the information that goes into the digital tax account. Now, the original proposal was for a 9-month window following the end of the accounting period. What that would mean was that for many of our traders who have 31 March or 5th of April year ends, this would spark a very hectic Christmas period, both for businesses but particularly for their advisors. Page 41 of HMRC's consultation response seems to give some extension to this, and it reads as follows. End of year activity has to be provided by the sooner of 10 months after the last day of the period of account or 31 January of the year of assessment in which the profits of the year of assessment for that period of account are chargeable to income tax. Now, Andrew Hubbard in his article points out that this doesn't actually look quite correct. And Andrew draws on an example. Let's take a year end of the 31st of December 2020. In the normal course of events, these will form the basis of assessment and will be chargeable to tax in 2021. 10 months from the 31st of December 2020 is the 31st of October 2021. The 31st of January of the year of assessment in which those profits are chargeable to income tax, as per HMRC, is in fact the 31st of January 2021. Therefore, what we think they mean is 10 months after the year of assessment in which the profits are taxed, which would take you to the 31st of January 2022. That's what we're hoping HMRC mean, because that would essentially mean that the same filing deadline that we are used to, as in that we do have an okay Christmas but a frantic January and we go off skiing in February, will remain very much in place going forward. But as I say, we need HMRC to clarify exactly what they mean by that statement. Now, let's turn to the all-important implementation timetable. Many comments were made in the consultation process on the ambitiousness of this timetable. And that core plan is not changing, in that from April 2018, Sole traders who are not part of the deferral until 2019, otherwise larger sole traders within MTD, will be required from April 2018 to start their quarterly reporting. VAT will follow in 2019, and 2020 will see corporation tax and large partnerships brought within this. So large partnerships are partnerships with a turnover of over 10 million. Other partnerships are going to be counted in from 2018. Now, what HMRC have given us some concession over is the fact that there will be no penalties for late submission of your quarterly returns in the first year, which in other words kind of extends the deadline out to 2019 because there's going to be no penalties imposed for 2018. So what they're basically saying is, do your best in year one, we won't sting you for penalties if you don't quite get there. But the question is, as advisors, we say, oh, we'll sit back and then wait till 2019. But we can't, we're professional advisors. What do we advise? Well, the law is the law. The law requires that from 2018, we must be advising our clients to comply with the law. So therefore, what I would advise is that we help our clients as best we can. Well, there won't be any penalties if they are late or getting things wrong, but what this will do is give us a year of sort of a practice run so that we're truly ready by 2019. And by that means that we'll actually get our clients to start keeping their records more regularly, keeping their digital records up to date so that this gets into the regular pattern and in the DNA of the business in readiness for when penalties are introduced from 2019. And that's the best advice I think we can give to our clients, is to get ready sooner rather than later. How will this impact tax returns? Well, how will MTD quarterly reporting fit with this whole process? Because many sole traders have other sources of income. Some might have an employment on the side with the P60, which is filed in the digital tax account. Some may have property income. Others may have trust income and dividend income. HMRC have clearly stated in their response that there will be one inquiry window. But I thought the ambition of making tax digital was to dispense with tax returns. That was the headline, after all, on the Daily Mail. And we can't argue with the Daily Mail, can we, really? But what the Daily Mail said was it's the end of the tax return. But we're going to replace it with the digital tax account. But it does seem it's not clear within the corridors of 100 Parliament Street exactly how MTD and the quarterly reports will true up with the annual tax return and personal tax account. But for now, it does seem that tax returns are still kind of going to exist, but they will all be done digitally through the digital tax account. We need more information on this before we actually can finally work out what this really does mean. So let's turn now to the costs and benefits. HMRC are still saying that making tax digital will bring in an additional £945 million worth of tax receipts to the Exchequer by 2021, which is basically the net impact of errors being eradicated. In other words, if businesses are forced to keep their records as they go along, which they essentially will have to do in order to meet the requirements of quarterly reporting, then essentially it will mean that they'll make less errors. But errors don't always go in the way of HMRC, because not only will businesses obviously make sure they include the appropriate amounts of income each time, but it means that where memories are fading when you're not keeping your records up to date on a regular basis, memories also fade on expenses. So if you're now meticulously keeping every single receipt and keying it in on a regular basis, you could be claiming expenses that you didn't claim before because by the time you actually did your accounts, you forgot what you spent the money on. So it could work the other way. But that's what they're saying. The net impact of errors is going to be £945 million in a year from 2021. They also state that there will be a total of £2 billion will be brought in by 21-22, which is going to be quite interesting. And my question really is the current error rate really that high? I'm not sure HMRC have sufficient data to work that out one way or the other, but that's what they're saying. Now, this is quite interesting. HMRC do now acknowledge that taxpayer compliance costs will increase, whereas in the past they said they would reduce. But they said they will increase while taxpayers make the transition from old world to new world, but then they will see a reduction from 2021 when essentially digital record keeping becomes part of the heartbeat and DNA of the business. And that the annual benefit for the economy will be £100 million in a year. Bearing in mind that there are 6 million making tax digital taxpayers out there, that's 16 quid per taxpayer. So I'm not sure exactly how beneficial this will be in reality. So to conclude, these are complex changes. We must remember that making tax digital is still going to happen. If we have been burying our heads in the sand up until now, it's time to pull our heads out and have a look around. Okay, there have been some relaxations in the introduction of penalties and in the allowance of spreadsheets with some conditions attached. But the picture is still very much the same as before. And I would strongly advise you, if you haven't done so already, to have a look at previous Tolley Seminars Online lectures on this very topic. Just in the search box, type in Making Tax Digital, and you'll find a whole array of lectures from various experts on this, including a few from yours truly. I also draw your attention to the free webinar that's part of the package that Rebecca Bennyworth and I recorded back in the autumn of 2016. There's still much work to be done and uncertainties to be cleared up. The timetable does remain really tight for all of this to be done. And will we all be ready? And when I say us all, I mean HMRC, the software houses, because they're fundamental in this, us, the tax agent community, and of course, most importantly, will our clients be ready? And will we be able to get them ready in time for April 2018? It's only around the corner. So there's a lot to be done and a lot to be thought about. Well, of course, we will be keeping you up to date with changes to where all this is going through Tolley Seminars Online. This is probably the biggest development in tax to affect us for many, many years. But for now, many thanks for listening to this lecture. My name is Chris Jones, Director of Tax Markets at Tolley.